March 2008. Bear Stearns vanished. 15 years later, Silicon Valley Bank and Credit Suisse collapsed almost overnight. Today, the official message is that regional banks are safe. But the data reveals a different story. Deposit outflows are up 40%. There are more than $500 billion in real estate losses, and warning ratios were ignored. Which 15 names are flashing red, and how close are we to a repeat? In May 2018, Congress passed S. 2155, a law that quietly redefined which banks would face the toughest scrutiny. The asset threshold for enhanced supervision jumped from $50 billion to $250 billion, instantly removing dozens of mid-sized and regional banks from the highest level of regulatory oversight. Banks that once had to run annual stress tests and submit detailed plans for surviving a financial crisis now faced far lighter requirements. The Federal Reserve, given new discretion, decided many institutions in the $100 billion to $250 billion range could skip the most rigorous checks altogether. For these banks, the change meant fewer mandated liquidity drills, less frequent capital assessments, and a longer leash on riskier activities. Former regulators warned that this shift left a large segment of the financial system operating under a looser net, especially as some of these banks grew rapidly to fill gaps left by the biggest Wall Street firms. Congressional debate at the time centered on whether regional banks really posed a threat to the broader economy. Industry lobbyists argued that the old rules were stifling growth, while some senators and former FDIC officials cautioned that risk does not disappear just because a bank falls below an arbitrary line. By 2023, the consequences of this policy decision were under renewed scrutiny. The failures of Silicon Valley Bank and Signature Bank reignited questions about whether lighter oversight had left cracks in the system. As the threshold rose, so did the potential for vulnerabilities to go unnoticed until it was too late. The regulatory rollback of 2018 set the stage for a new era of risk, one where warning signs could build up out of sight, only to erupt when stress returned to the banking sector. A closer look at the numbers reveals a set of warning signs that risk analysts and regulators watch closely. Deposit outflows are one of the clearest alarms. In recent stress events, some regional banks lost as much as 40% of their deposits within a single quarter, most of it uninsured, most of it gone in days, not weeks. That kind of flight isn't a system-wide average, but when it happens to a vulnerable bank, it can trigger a run that is nearly impossible to stop. Commercial real estate sits at the center of the storm. Across U.S. banks, roughly $2.5 to $3 trillion in commercial real estate loans are outstanding, with regional lenders carrying a heavy share. Stress tests and independent research suggest that in a severe scenario, $300 billion to $600 billion of these loans could be at risk of default or loss, with about $500 billion as a working midpoint. Office buildings in particular are struggling to refinance as values drop and rates stay high. Interest rate risk is another silent threat. Regulators acknowledge that more than $500 billion in unrealized losses remain on bank securities portfolios. Some independent studies that apply mark-to-market accounting to both securities and loans estimate that the hidden hole could reach $2 trillion in a severe shock. That is not a booked loss, but it is a vulnerability if banks are forced to sell assets to meet withdrawals. Analysts flag 3 tripwire ratios as immediate cause for concern. Tier 1, capital below 8%, loan-to-deposit ratios above 90%, and more than half of deposits uninsured. These thresholds are not just academic. They mirror the patterns seen in the 2023 failures. When a bank falls below these lines, it is not just a number on a spreadsheet. It is a signal that the margin for error has vanished. This is a clear warning. Zions Bancorporation stands out for its high share of uninsured deposits, a funding mix that leaves it exposed if large corporate or institutional clients pull their cash at once. Much of its loan book is tied to commercial real estate in the West, creating a double risk: property values under pressure and a deposit base that can move quickly. Comerica's balance sheet reveals a heavy tilt toward technology and venture-backed clients, echoing patterns seen in 2023 failures. When tech markets slow, deposit outflows can accelerate, making stability a challenge. KeyCorp's stress lies in a commercial real estate portfolio deeply tied to struggling office and retail sectors across the Midwest and Northeast. As refinancing costs climb, the risk of losses grows. Regions Financial, with a business model sensitive to swings in interest rates, is feeling the squeeze as margins compress and funding costs rise. Fifth Third faces headwinds from the Midwest's uneven recovery, with rising credit losses and a loan book exposed to sectors hit hard by economic slowdowns. A banking analyst says these institutions show the classic warning signs: concentration, exposure, and thin buffers. If stress spreads, each could become a pressure point for the system. PacWest stands out in California, where commercial real estate loans make up a significant share of its portfolio. As office values fall and refinancing gets tougher, analysts watch for signs of concentration and stress in these concentrated markets. Western Alliance, meanwhile, faces a different challenge. A large portion of its deposits come from a handful of business partners and fintech firms. When those clients move their money, the impact on liquidity can be swift and severe. First Horizon, with deep ties to the Southeast, is exposed to regional slowdowns that ripple through its loan book. Huntington's auto lending business has come under pressure as used car prices fall and delinquency rates rise, threatening credit quality. M&T Bank, heavily invested in Buffalo and Rochester, is vulnerable to local economic swings that could hit both commercial and consumer lending. Taken together, these 5 banks control about $1.2 trillion in assets. In a severe scenario, as much as $400 billion in deposits could be at risk of flight, leaving a potential FDIC insurance gap of $150 billion. One banking analyst notes, these concentrations amplify risk. If confidence cracks, the numbers move fast. Associated Bancorp draws attention for its outsized focus on agriculture lending across the Midwest. When crop prices fall or weather turns, even a modest rise in farm loan delinquencies can ripple through its balance sheet faster than at more diversified banks. Valley National, rooted in New Jersey and New York, sits on a large portfolio of commercial real estate loans tied to aging office buildings and urban retail, sectors where vacancies and refinancing hurdles are mounting. Synovus, serving the Southeast, faces a different kind of concentration. Rapid population growth and construction booms have fueled lending, but if the regional economy cools, those same loans could become a source of strain. Hancock Whitney's exposure to the energy sector means swings in oil and gas prices can quickly affect credit quality, especially as smaller producers face tighter margins. BankUnited, with deep ties to Florida real estate, is vulnerable to property value swings and insurance shocks in a state where climate risk is never far from mind. Despite these sector quirks, some bank leaders insist the fundamentals remain sound, describing current pressures as temporary and manageable. Yet one chief executive officer says we have weathered storms before. This time, we are watching the horizon more closely. Deposit runs that once took weeks now unfold in a matter of hours. In March 2023, Silicon Valley Bank saw over $40 billion in withdrawal requests in a single day. That event shocked even seasoned regulators. The mechanics of a bank run have changed, with social media chatter, instant messaging among depositors, and automated online banking tools allowing fear to spread at the speed of a trending hashtag. As soon as negative news hits, corporate treasurers and startup founders can move millions with a few taps. An analyst from a leading risk consultancy summed it up. What happened at Silicon Valley Bank was not a slow burn. It was a digital stampede. This new reality compresses the timeline for bank management and regulators to respond. The window to stabilize confidence has shrunk from days to mere hours, raising the risk that liquidity shocks can ripple through the system before traditional safeguards even activate. A credit shock on the scale analysts now contemplate would echo through every corner of the economy. If a wave of regional bank distress forces even 1/3 of these lenders to pull back, the result could be a contraction in available credit approaching $800 billion. That shortfall is not just a number on a chart. It means fewer loans for small businesses, tighter mortgage approvals, and stalled construction projects in cities and towns across the country. Federal Reserve models and research after SVB both point to the same conclusion. Large banks and non-bank lenders can only replace part of the lost lending. The rest simply vanishes, leaving households and companies to face higher borrowing costs or no credit at all. In severe scenarios, that gap is enough to tip local economies into recession, with job losses and business closures radiating outward from the banking sector. As one regulator put it, when regional banks pull back, Main Street feels it first and hardest. Financial systems run on trust, not just numbers. When $400 billion in uninsured deposits sits exposed, confidence can vanish faster than any regulator can react. Today's warning signs aren't just forecasts, they are stress tests for our vigilance. In the end, stability depends on what we do next. Share your thoughts below.